We've had quite an intense and fulfilling 2.5 days of learning, and we're in the last session of the program. Uh, this is a question and answer session, and any questions on any of the topics that have been covered in the past 2 days, or any questions that you have which is out of the program as well. So this is the time for you to ask that question to Professor.
So the question is regarding risk. One risk that especially monopolistic, natural monopolies, not regulated monopolies. So especially those kind of companies who earn outsized profits, they're targeted by the regulators because for some reason they don't like companies making too much money. So in that case, how do we look at the regulatory risk? For example, Microsoft or Google being tried to the regulators trying to break them up. But even in context of Nepal, there may be some companies who are earning those kind of profits. And natural monopolies are very difficult to sort of break the moat. But there is that regulatory risk if they just decide. So how do you look at that?
This is a very interesting question, and let me step back a bit. On the spectrum of the business qualities, there's a usual belief that monopolies are the best of them all. And perfect competition is at the other extreme, which is the worst quality business. But really, I don't think that's true. So, if you have on one side perfect competition, which means you don't have any pricing power, everybody charges the same price. But you are the lowest cost operator in that industry. And therefore, you can earn the highest margins and the highest return on capital. That's a great business. If you are invested in that kind of a business, then your main thing is to remember, to focus on is that where does this cost advantage come from and how durable it is. Can it be copied by somebody else? If it can't be, then you got yourself a very good business, even in a perfect competition commodity side of the spectrum. On the other side of the spectrum, we have monopolies. We have businesses which are monopolies, natural monopolies. You're giving an example where you're making insane amounts of money, and people don't like businesses making insane amounts of money. Here I want to highlight the formula that I cited on the screen a while back, which is the compound interest formula, where you have a terminal value, you have the initial sum, and you have a rate of return, and then you have a exponential factor, the period over which you want to make that. Now, I want to add in the factor of greed. Supposing you're a greedy monopolist and you can charge whatever you want to because the customers don't have any choice, they have to buy a product. If you're a greedy monopolist and you charge whatever you can, you are going to maximize your near-term earnings. But you're for sure there is going to be some regulatory backlash or a consumer backlash. So I'll give you some examples. There was a company called Valiant Pharmaceuticals in the United States. They had monopoly rights on certain drugs. They would buy some drug patents and they would jack up the price of some life-saving drugs by as much as 2,300%. Now you can do that, and of course the consumers are not going to love it. And they're doing it with life-saving drugs. Now contrast that with See's Candy, which Warren Buffett also owned, which was a loved business, but he increased prices slowly, year after year, and nobody noticed it. The consumers were effectively boiling frogs. They didn't even notice it. The point I'm making is, if you act like a greedy monopolist, then you're attracting trouble. It's far better to stay below the radar of the regulators, not earn that much money in the short term, make good money, but increase the durability of the business model, focus on the end of that equation, whereas we're focusing on the durability of the business. I think that's where the sweet spot is. You're right that if you're a natural monopolist, if you are making insane amounts of money, there will be some people who will be unhappy about it. It could be the consumers, it could be the government, it could be the tax authorities, it could be some regulator. I don't know. And that's the threat that you have to worry about. So absolutely agree with you on that.
So, Professor, during the 2.5 days and throughout our journey, so we've talked about value investment. I want to ask about value divestment. When do you exit? In relation to, there will be instances in the short run where the markets will, you know, act differently, and then the pricing might go up. It might not make sense. So do you exit during those periods? Also in relation to, as you mentioned, that, we should not keep the cost of our purchase, while analyzing the stock. So if you're not doing that, so you would have instances where your, let's say, the value and the market price are very close, or the market price is above the value sometimes. And there could also be instances where um, the business is so good that, if you, even if you sell now, but then the profits will catch up and the growth will catch up in the future. So when is the right time to sell?
Nobody knows for sure, but there are ways of thinking about it. The sell decision is a harder decision than the buy decision, because sell decision has a lot of psychological, influences that come into play. You are in love with the thing, you remember the cost, or the whole lot of things that happen. Now, one way to think about selling is to not really think sell, but think switch. The moment you do that, you become more objective. Because if you're thinking, I should I sell it or not, then you're in love with it, it's gone up a lot, it's made money for you, you're at too much attachment, endowment effect, all those things that we talked about, they're coming into play. But the moment you see there is something else which is qualitatively better, significantly, and is also available at a valuation multiple which is significantly better, why am I not switching from this to this? If I'm a fiduciary, should I not, why should I? You need arguments. Maybe it doesn't make sense to switch. But the moment you have something to compare it with, some opportunity which is very compelling to compare it with, then it makes it easier for you to become more objective about the whole thing. Otherwise, you're going to keep on, your mind is going to keep on getting messed up with the cost and how much money you have made, and it will go up. Abhi to party shuru hui hai. All those things will come into play. So that's one possible solution to the problem about selling. The other reason to sell is to acknowledge that you are wrong. You're going to make mistakes. You have to understand that this investing is a probabilistic game. You're not going to be right all of the time. Even the best investors have made mistakes, are making mistakes, are going to make mistakes. You remember the video we saw of Roger Federer? World champion, got only 54% of the shots correct. I mean, 54% of the points he won. He lost 46% of the points. The world champion. So the hit ratios are nowhere close to 100%. You're going to have mistakes. So the important thing is to recognize that a mistake has been made and to correct it. And again, doesn't matter what you paid for it, doesn't matter what you told your clients, doesn't matter how much pounding on the table you have done, doesn't matter what you thought, how much you are in love with this idea. You were wrong. And you're wrong not because your analysis was wrong, but because the circumstances have changed. It could be all sorts of reasons. Maybe you're wrong in your analysis, but the world shifted, the regulatory environment changed, things that you could not have visualized happened, the major disruption happened. There are all sorts of reasons that could cause a good idea to become a bad idea. And when that happens, try to be as honest as possible and get out. Even if you don't have an alternate opportunity. In that case, the switching is cash. You are switching to cash. Cash is better than that. Right? The third reason to sell is the stock's gone up so much that I'm not able to sleep at night. Again, there are no numbers here. I cannot give you a formula that, when it gets to 20% of assets sell, or when it's 15% of assets sell. Some people have a 100 stock portfolio, some people have a 10 stock portfolio, some people have a 5 stock portfolio. So it all is basically, the idea is to sell down to the sleeping point. If it's giving you too much of anxiety that, it's gone up a lot, of course it's made money for you and all that, it's become a very large percentage of the portfolio. So you want to, so from a risk management perspective, the exposure levels have gone up, and that's risk management. The same thing in banking. If you're a banker, if you lend money to a particular client, you want to limit the exposure, no matter how good the client is. Because shit happens. There is this unknown factor that can come by. And when that happens, so the probability may be low, but the consequences are very bad. So you're thinking about the consequences of the probabilities. So you're trying to curtail your over-optimism, and you're justifying it by saying, look, I'm not getting out of it. I'm just filling it down to the sleeping point. I still, if the company keeps doing well, I'm still going to make money. It's just from the risk management point of view. You see, the skills required to buy a stock, to initiate a position, are not the same as the skills required to manage the risk on a portfolio. Portfolio management risk skills are very different from the skills of portfolio of initiating an idea. You have to think like a risk manager of an insurance company. You have to think like a risk manager of a bank. What is my exposure level? What if some shit happens? What are the correlations between different positions? So that's another reason to sell. The fourth reason is an unfortunate reason, which is that you're structurally not in a very powerful position. You are running an open-ended fund, or you have short-term money, or you have debt, or your clients are pulling the rug from under your feet for whatever reason. That's unfortunate, but it happens. You don't have a choice there. Then price and value don't matter. So try as much as possible, not always possible, to limit those kind of situations. Try to have structural strength, because if you are investing in value, there will be pain periods. If you are a long-term investor, you're going to have asset liability mismatch. If you have short-term money deployed in long-term assets and the money is pulled out for whatever reason, you'll be forced to sell at the wrong time. Try to minimize those situations. It's not completely possible, but to as much as you can, it will reduce the amount of stress that you have in your life.
From the previous question. So, as we discussed about cyclical companies like the shipping yard business, and we looked at the framework of Tobin's Q, where we bought at maybe 0.5 or 0.7 times of its EV to replacement cost value. But then while we sell it, do we like sell it once it reaches to the one multiple of Tobin's Q, or do we wait for the cycle to pick to a better extent? So just like you told that the shipping yard business, the topic skew metrics went up to 5 times, but then most of us would have sold it at 1 times or 1.5 times. Is it the right approach to do, or do we wait for the cues for the cycle to revert again and then only do we sell in such cases?
So when I talked about Tobin's Q, I was really not talking about when to buy and when to sell. I was talking about how cycles occur and how cycles turn and how the incentives play out, and how Tobin's Q is like a there's a a reversion to the mean. How Q is like an attractor. In the long run, in businesses where low entry barriers, there is no particular reason why the market value of the firm should be any much different from the replacement cost of the assets. There are some exceptions, but we're not getting into that. But whether you should wait for it to go to 3, 4, 5, I don't know the answer to that. Basically, what I'm trying to tell you is that you should be aware that this is a cyclical industry, and if you study past cycles, Tobin's Q does go below 1 and goes well below 1. At that time, there are incentives created for consolidation in the industry, and you could then be a good time to start looking at the lowest cost providers or producers or service providers in that industry at that point in time. And then you're not timing the cycle. You don't know when the bottom of the cycle is. You don't know whether you should let it go to 0.5 or 0.3 or 0.2. But you can always buy more of the stock as it keeps coming down, because you know the business is strong and it's going to bounce back because the cycle is going to turn. That's one way of thinking about it. The other way to think about it is all shortages will produce gluts, because the incentives are such. We talked about that. The incentives are crazy. People can't stop themselves from expanding recklessly, and a glut is coming. When you know the glut is coming and the Tobin's Q is short of right now, it's a warning signal for you to get out. Whether you want to get out at 3, 4, 5, I don't want to comment on that. It will also depend upon the other metrics like earnings multiple and alternate opportunities available to you. So why do you want to limit yourself to only one tool in the toolkit? You don't want to end up like a man with a hammer syndrome. You have other toolkits. So again, don't think sell, think switch. If you have other opportunities that are way better and the Tobin's Q has gone way above 1, maybe it's time for you to say goodbye.
Professor, I just want to ask about the investment mistakes, the thesis which did not play out well in your cases, and what have you learned from the behavioral lenses as well as the things from the analysis side?
So I'll urge you to read Safir Anand's book. He wrote a book recently on mistakes, and I'm sure you know of him. He's very well known in Indian value investing circles, and you would have seen him very active on Twitter. So he's also a friend, and he invited me to write a chapter on in his book, and I wrote about two kinds of mistakes. I'm not going to name the stocks. I don't want to make it stock specific, but I talked about that in that chapter. So I urge you to take a look at that chapter, or any other chapters in that book, basically, because that book is on mistakes.
Sir, sometimes you're in a dilemma that you can't find a very good company. You don't. You just find average companies, or sometimes the good companies, the price have shoot up a lot. So in those cases, do you think it's better to invest in a good company, or should you pile up on cash or wait for the good company for it to go down?
So it's a very tough question to answer. Firstly, this was a big problem earlier. Indian markets have grown, and we have 4,000 plus companies. That's one. The other is you have to be a pragmatic investor. If you think you will get the best quality company with the best quality management and the best valuation, not going to happen. Which means there have to be compromises. It's like marriage. You so there has to be a compromise. I hope my wife doesn't see this. Uh, uh, so you have to, and the compromises can come. Okay, I'm compromising a little bit on quality, but my God, look at the valuation. It's insane, insanely good, not bad. It's insanely cheap. So that's a good combination. Or you can say, well, the management could be a little better. They made a few mistakes and they have acknowledged those mistakes, and hopefully they will not make more mistakes. But look at the structural advantages in the business. The management is fine so long as they don't do anything dumb. It's okay. The main strength comes from the business model. That would apply to many of the government-owned companies, because they have the strength of the. It does. You don't even need to know the name of the manager of the company, because they have license to print money. They are monopolies. They have order books. They have people who are executing their order book. They have debt-free balance sheets. They have high dividend payout ratios. They have insanely cheap valuations. The management quality aspect of that is limited to, please don't do something to screw this company. Just come to office, do your work, go home. And you know that by being a government company, it's unlikely that suddenly the guy will wake up and say, today I want to go and do an inorganic transaction in Africa or something. I want to buy this company or that company. To be sure, there are all kinds of nutty things government companies can't do because they are government-owned companies. Of course, it's offset by some stupid things that the government will make them do because it's in national interest, but not necessarily in the interest of shareholders. You have to be worried about that risk also. So when you think about all these moving parts, there are all these moving parts, but there is this valuation part from Graham. If you can get a really reasonably good quality business, but you're paying a Ben Graham kind of a price, I think by and large it's a very good combination for it to get into the portfolio. That's level one. Level two is the diversification. This is not the only stock that I'm buying. I'm buying 20 other stocks or 15 other stocks or 10 other stocks, depending on what's your diversification policy. But the point is, you are getting the benefit of being a pragmatic investor on quality dimension of the business and the management and the valuation. If the business is extraordinarily good and it's going to grow and grow and grow, you will pay up a little, not a lot. You're willing to pay up for quality. So you will make that compromise, because you will never see the low valuation. You're looking at the earnings 5 years out or 10 years out. What Arpan was saying about one of the companies that he was mentioning. I will not name it. I don't know whether you want me to name it or not. But there are some wonderful companies in your country which are multinational, which have monopoly products, branded products, which are selling at reasonable multiples. So if you're owning them or if you're contemplating buying them, you're looking at buying. You're paying for 15, 16, 17 times earnings for them. But you're looking at 10 years out or 5 years out, or some future period during which the earnings will be much higher than what they are right now. Not the same as buying something at 5p multiple. So you're making a compromise. Where is the compromise coming from? I'm paying up, but look at the quality of what I'm buying. So that kind of a thinking you have to do. You're like a curator of an art. So you have to have all things in your mind: the quality of the business, the management, and the valuation, and then the diversification.
I belong to a life insurance company, and typically for us, what I've seen is that, especially in the current time, is that interest rate has been a most challenging factor for us. Where in Nepal, in context, it was around 10% plus, but now it is hovering around 3 to 4%. The biggest challenge. Uh, Looking at one part of the challenge, the interest rate, the other part, what we see from a regulatory aspect is that there are new things and emerging concepts which are coming, like the ESG framework, the risk-based capital regime, the IFRS 17, which is the world is talking around, the sustainable development goal, carbon credits. The challenge what we feel from a value creation perspective is that on one side you have the global regulators and the local regulators who are trying to push these new concepts, which is more on a value creation, but it takes time to generate the return. So how do you see from your lens that maintaining returns from a current standpoint of view is important, but on the other side, these things takes time eventually to generate returns. So just trying to know your view from a value investment perspective.
Sure, I can do that. But before I do that, I want to ask you about the interest rate part. What was the relevance of the low interest rate? How is it a challenge for you? Have you given out promises on life insurance to customers which are fixed?
We don't have a guaranteed products here in Nepal, but typically the mindset of the policy holders and of course the distribution channel is that it's more of a guaranteed. So typically for a correction, when we go for a revisionary bonus correction, typically it put a hiccups to the market, and you immediately
So basically, you may not have a guaranteed return on paper, but it's sort of
yeah, the
is
mindset
expected by them, and it was.
which is the policy holders reasonable expectations what they
So your problem is that in a low interest environment where you're required to put a lot of money in fixed income, you're not able to generate the income to honor the returns,
yes.
which is why you have to reduce the bonus payment.
Use our bonus rate, but how do you do a value investment and so that you keep countering? But again, the other side, there is a bigger challenge of the
No. I don't want to answer the question by saying how can value investing save you from this mess. The mess is because you made that promise in the first place. There's a structural problem here. If you recognize what is happening, we talked about that from a risk management perspective. If you're given out promises in fixed dollars, whereas the income to produce to honor those promises are in variable dollars, and those dollar returns have gone down, in this case in your local currency, then that was structurally a bad idea. So if you want to really solve this problem going forward, you should not have any policy where you are having those promises. It should be back to back, it should be the same, it should be variable, right? That's one that, so that is a more durable solution. How value investing can solve you, I can't help you, but there are a lot of value investors here who will help you. You hire them. They are, they're budding value investors. You can use their services to help you find wonderful businesses to invest in Nepal to get you. Because I'm not the right guy. I have zero, understanding of the value investing landscape in this country. Now, you had another question about the ESG part. You see, I think ESG is here for us, is here there with us. They've gone a little bonkers on one aspect, a few aspects, but I do accept the fact that for some people, pro-social business models are a good idea. I actually love pro-social business models. I have talked about in the past investing in Narayana Health, which is extremely pro-social, run by a social entrepreneur, Devi Shetty. I've talked about pro-social business models which don't do harm to society by staying away from things like tobacco and alcohol. But I do love addiction, so I've gone towards coffee. So when I'm investing personally and for my clients' capital, I have my own ESG framework. Basically, I don't like businesses which will get into predatory lending practices, for example, or which will get into things which are into gambling or into something which is a zero-sum game. I like positive sum games. So that's the way I'm made. That's the way my partner is made. So while we don't call it explicitly an ESG framework, but we have that framework. I think everybody has their own value system, and I don't want to impose mine on anybody over here. You are an institutional investor, you have to comply with the norms. I can help you there, but it is very onerous. I get that. There are a lot of things that you can't do because of the ESG, but I don't think there's a contradiction here. Good businesses which are good for society can also be very valuable and very wealth creating, and can also become great investment. I don't think there's a contradiction. You cannot say that it's ESG, so returns should be low. I don't agree with that part. You could have really good quality pro-social business models which are net positive for society, and are also great businesses which momentarily can become available as great investments as well. And that's the job that we should have, we should aspire for.
How can we integrate the Base Theorem into our investment processes, especially if there is a large factor or large number of factors which are not so easily quantifiable?
See, the idea behind Bayes' theorem, as I laid out, was never to quantify it, but to understand the intuition behind it. So there are, a few big lessons that come from that. One of them was that, be sensitive to base rates. Don't ignore base rates. So people fall for stories. People get in love with a certain person and they think that I want to invest with this person without going into the details about the nature of the business that he wants to get into. Um, to be sure, there's nothing wrong by being charmed by a person. You have known the person for a long time. He has a good track record in creating value in the past, but he's going in a different business. It's the restaurant business. So look at the graveyard of restaurants and see how many of them are there, and you'll find there are lots over there. And you'll find that the average lifespan of a restaurant is typically less than 5 years. So once you know that, and when you balance that piece of information with the information about what this fellow is about to do, whatever he's setting up a restaurant in a high street of Kathmandu, where the cuisine has never been served before, and there is a lot of demand for that. Although those are favorable factors, but to only focus on these favorable factors and ignore that the statistical odds of succeeding in the restaurant businesses are not that great would lead you to a very flawed sort of analysis. So that's one big lesson that comes from Bayes' rule. The second big lesson that comes from Bayes' rule is obviously that there is new information coming in. So don't get stuck with old views, don't have rigid views, don't be cocksure about anything. There are things that happen that should force you to change your mind. So focus on information that becomes a surprise. It could be positive surprise, it could be negative surprise. Incorporate that in your daily thinking, in your monthly thinking, weekly thinking. Not everything should be signal. Most of it is noise. So learn the art of distinguishing between what is important and what is unimportant. And if what is unimportant should be completely discarded because it is noise, but what is important could be already incorporated in your investment hypothesis. If the business is great and some news comes that it is doing something wonderful, that's no big deal. But if you find that they've done something terrible, that's news. That's solid disconfirming evidence. So you should incorporate that in your thinking. A Bayes' rule, the intuition behind it, teaches us exactly how to do that. Bayes' rule also teaches us that sometimes the changes in the mind should happen gradually and sometimes they should happen very, very quickly. So we see that the analogy of that in the world of business. Sometimes the company is announced, found to be a fraudulent company, which means you have to very quickly change your mind if you unfortunately are invested in that stock. Satyam was the case in point many years ago. There was this company which was found to be fraudulent because the owner of the company, the founder of the company, confessed to the markets that I've committed fraud. So Bayes' rule tells you that this is not, you don't have to wait. Basically Bayes' rule tells you that you change your mind about this particular stock, no matter how much diligence you have done, no matter, all that is irrelevant to the situation. And in some cases it tells you to change slowly. So how disruption is playing out, how businesses are getting worse over time, or how moats are emerging, how business is getting better over time, the markers of quality are improving over time, how margins are improving, how cap turns are getting better, how debt is going down, how the product profile is getting better, how the customer concentration risk is going down, how the vendor concentration risk is going down. Businesses are not static, they are getting better or they're getting worse. If a business is getting better over time, this is new information that is coming in. So you have to incorporate that in your thinking. Well, the way to do that, I think, is to think about position sizing. So if it was initial purchase for you at 1 or 2% positions, after a few years when you monitored the company and then seen that the business has materially become bigger, better in many ways, and you can objectively quantify that and document that, but the valuation is still very attractive, then why would it not warrant a higher position? It should, and that's exactly what Bayes' rule tells you to do. So this is exactly what the intuition of Bayes' rule is.
Do we treat money as a commodity and believe that it has a diminishing marginal utility, or we could never do that because we keep on inventing new things that we can exchange it for? Why I ask this question is I keep on going back to that 1,000 rupees I saved on that car
Because if I have a net worth more than that, uh, isn't my time valuable? 10 minutes is more valuable, and I leave that $1,000 because of everything, every modern things like busy time, decision fatigue, and all.
The example on the 10,000 rupee lamp and the 10 lakh rupee car was just to illustrate that money is money. Money is fungible, and $1,000 is $1,000. In either of the two situations, you are by spending 10 minutes of your time, richer by $1,000. Now, whether you save $1,000 on buying a lamp or $1,000 on buying a car is the same $1,000, right? In both cases, it was implied that he has the money to afford both the things. So it's not like your net worth would have materially changed. It changed by exactly the same amount, and in terms of percentages, it really is a rounding error. It's not significant. So what that means is that if you think about it from that point of view, then the utility of that money is the same. Whether the $1,000 that you save on the lamp is not going to buy you anything more than the $1,000 on the car. So you should discard the words car and lamp and 10,000 and 10 lakhs. You should ask a very simple question: what is the effort that I have to put in? 10 minutes of the time. What is that I am going to get in return for that effort? $1,000. So you can't say that I am willing to save $1,000 on a 10,000 rupee lamp, but I'm not willing to save $1,000 on a 10 lakh rupee car. It's inconsistent with rationality. So that's my answer. As to your question about other ways of wealth creation, my answer is that invest in productive assets. To be sure, there is this argument of scarcity in things like gold, for example, or some piece of land which is not replicable, or a piece of painting that is not easy to replicate, or cryptocurrency which has got scarcity. And I have an open mind on that, but that doesn't mean that I am going to invest in that, because I have overwhelming bias in favor of productive assets that generate cash flow. Because when assets that generate cash flow, I have an income return coming in. And as income goes up, and many of those assets are inflation hedges, as inflation happens, then those income returns tend to go up over time, then the nominal value of those assets will also tend to go up over time. Now contrast that by putting money in a fixed income security, where you get a nominal return that is absolutely fixed with no upside. I don't like that asset class. So I don't like debt, except when it is parked as a temporary place for money to be deployed in productive assets, which are basically businesses. So I like to invest in businesses that are generating money, and instead of putting money in non-productive assets or asset classes with a capped nominal return with no upside like debt. So but that does not mean that people should not think of gold as an alternate asset class, or land as an in some remote part of your country as an asset class where some development might happen and the land might appreciate over time. It's not producing anything right now for you. Who knows what will happen after 20 years? I don't have that kind of patience, and I don't want to even say that crypto should not be invested in. It's just not my game.
How do you decide whether a stock should be 2% of your portfolio or 10% of your portfolio?
There's no right answer. Nobody knows.
The value investing principle states that you should base your portfolio based on your conviction. But how do you put that into numbers? Is there any formula that you use?
So there are many styles of value investing. When you talk about value investing, what do we mean? Are we investing like Philip Fisher in very high quality, what we believe are like really high quality businesses with durable competitive advantages, or are we investing like Benjamin Graham, Walter Schloss, which are statistically cheap businesses? If you're in that part, which is absolutely okay, then obviously you need more diversification, because the error rate is higher over there, and those things you need to get out fairly quickly, because they were never great businesses to begin with. If you end up with a great business over there, it's not by design, it's by accident. Whereas over here, you are excluding mediocre quality businesses selling at very cheap valuations. You are inherently biased towards good quality businesses. Of course, so now the next question becomes, how many good quality businesses are there? By definition, great businesses are going to be few. And then we add the fact that how many great businesses become available at a valuation which is cheap enough for a value investor to be excited about? Even fewer, because most of them are already discovered, right? which means that there are going to be few opportunities, which means naturally you should have a concentrated portfolio if you are investing in high quality businesses. And as you move on the spectrum toward Ben Graham, Walter Schloss kind of investing, you should have more numbers of more names in the portfolio. How many names over there and how many names over there? Nobody has the right answer. At one time, Walter Schloss had 100 stocks in the portfolio. I have known people who have 3 stocks in their portfolio. Lee Lu believes in extreme concentration. Charlie Munger used to believe in extreme concentration. My own preference is to have somewhere between 10 and 20. My sweet spot, me and my partner's sweet spot, is about 15. Right now, for our clients, we have 12 names in the portfolio. My own personal portfolio has 5 names. Now, what should you have? I don't have an answer to that. But I do know one thing. My own thinking on the subject has changed over time. So, and so once in a while, when you are overconfident and you have a concentrated position and the overconfidence hits you, you realize that, I was too much into that. So that will change and you have more diversification. So it all depends upon your own experiences, what you are comfortable with. But there are basic principles that as you move towards quality, you are going to have more concentration. As you move towards statistically cheap bargains, you need more diversification.
So as value investors, we kind of have to be a contrarian in the market. And how do we maintain conviction to a certain degree and not make it into, overconfidence? So where do we draw the line?
Good question. It's a great question.
And you just mentioned that in your personal portfolio and your client's portfolio, there are different number of stocks, right? And yeah, I guess clients have different demands, different goals and everything.
They also have more money.
Yeah. So apart from that, when you're managing your own money and when you're managing someone else's money, what kind of differences in approaches that you take?
So I'll answer the second one first, which is basically that none of the stocks that I own are not already owned by the client. So I don't buy anything if the clients already don't own. The reason I have fewer is because when I had the money, the opportunity had gone. You have to time the money with the opportunity. When the client gave the money, there were opportunities and I deployed the money over there. But when I had the money, the opportunity had gone. So that's why I'm limited to a smaller portfolio. But there is not a single stock that I own that the clients also don't own. So that's the easy part of the question. The first part of the question was on conviction and overconfidence, and you don't have to be a blind contrarian. You have to understand, and people figure if you don't get this, the market will teach you. Sometimes the market is right. If you think that you know better than the market every time, you will pay a very heavy price for that. So you buy a stock and it starts going down. And you think, oh, the market doesn't know anything, I'm going to buy more of it, I'm going to buy more of it. And suddenly after some time the company announces that they lost a huge customer. And it turns out that this was a very significant information that was available to some selected people who knew that and they were dumping the stock, and you are in a sense like a patsy in the game. The famous quote, when you're playing poker, there's a person who's the patsy in the game, and if you don't know who the patsy is, you're the patsy. So you don't want to end up in a situation where you're the patsy in the game. The market is sometimes correct. So overconfidence can come from oversized positions or being stuck up with your ego, not letting go of your ego. That there are all these developments that are happening which are so negative, and the market participants have figured that out and they are already abandoned the ship, so to speak, and you're still on it. Why? So you need to be able to, and that's where the help from others have to come, because you are so emotionally attached to this thing. That's why this set of people can help each other. That they can de-bias you. They can get you out of your denial by talking to you. That why? What is the logic? Would you buy this today? I want to hear reasons. Like in the movie you saw yesterday. He said, I want to hear reasons. I don't want to end the story right now. Give me the reasons for your logic. I want to hear the logical reasoning as to why you think he is not guilty. So it's the same Bayesian reasoning that you have to do. Yesterday's movie was on Bayesian reasoning, right? And how one guy, by just being a Bayesian and very patient and very psychologically astute, could turn around the table and get 11 others to agree with him. And how some people were so stuck up, so cocksure, so confident that this is the guy who is guilty for all sorts of prejudices that they had, and they would not let go of their prejudices right till the end of the movie. We don't want to be like that people. We want to be like the protagonist of the movie, that we are able to change our minds as new information comes in, and we are able to help other people change their minds because they are stuck up in their own delusional world. So I think this is what you will learn automatically over time, because if you don't learn it, you will be out of the game. You will not be on the table.
Thank you, Professor, for being with us in this workshop. As you said, Nepalese capital market and is catching up Indian capital market by, and our capital market is lag behind 5 to 10 years. What are the three suggestions you, as a guru, I'm asking as you as a guru, what are the three suggestions that Nepalese capital market as a regulator should implement to minimize that catch-up period?
I would not want to minimize that catch-up period because that gives you a strong leeway. I'll tell you why. It will catch up, but while it catches up, it gives you an edge, because you can cross the border and look at the future and go back. Because what's happening here is what will happen in your country, as was my interaction, limited interaction with some of you have done. I told you that you're telling me the kind of scams that India has seen, you are seeing right now, or you are going to see. The kind of manipulative practices that India has seen in the last 20-30 years are happening in Nepal right now, and those loopholes are going to be plugged. So the solutions are here. Just study the evolution of regulatory markets in India. So the answer to the question is, what are the three things that can happen? You can study the changes of regulatory. It could be things like settlement cycles. It could be shifting to demat accounts. It could be T+1 trading. There are all sorts of things. It could be electronic trading instead of open outcry. I don't know what is the real way in which you guys trade stocks over here, but moving in that direction will make it more transparent and less prone to abuse. All of that is good. But the kind of inefficiencies that I have experienced when I was starting out over here was so insane, and I'm sure that you have seen similar things over here. Why would you want those inefficiencies to go away? That's where you make money. Because the market is small, because it's fairly illiquid, because it's not being dominated by global investors, because nobody is tracking it, competition is so less right now. So you establish your position in the market by doing all the research, have becoming expert in all these companies, and as the number of companies go, as I was told, there are a lot of companies that are going IPO. Stay away from the IPOs, but post IPO, after a few years, these companies, some of them may be great businesses available at a really, really good valuation. So the number of companies are going to grow. So you don't want to reduce that edge. So if there are inefficiencies in the market, you want those inefficiencies to stay there. So I don't really want that gap to narrow. It's in your interest for it to not narrow. Appeal to interest, not reason.
My specific question is on mean reversion. My personal experience in my investing journey, first, like straight out of college, reversion to mean was taught in finance, not in terms of business analysis, but in terms of finding out stocks that were trading below their traditional mean and then buying them and expecting them to catch up. But that never worked out. That's when I met Arpan, and then we started focusing on business analysis as opposed to only investment analysis or financial analysis. That's when this mean reversion concept was completely out of my mind. I stopped using it altogether. And then later, fast forward a few years, I met a few friends both in India and in Nepal who made money using this same concept. So my specific question to you is, these are mental models, right? Whatever you taught us for the last 2 days, but it's very easy to either over rationalize them or completely disregard them. So how do you, like, what practical insights would you want to share with us in terms of using all the mental models that you've shared with us, including mean reversion?
I can't do all of them because that will take another 2 days. But I'll address the mean. I think you already know the answer because you yourself have gone through the journey that you appreciated a model, you learned about it in college. Typically, it's taught in statistical courses. And then you thought that, hey, it can apply in the world of business. It can also apply in the world of investing in financial markets. and then you tried to apply it in a limited manner and it did not work, and then you found an application of that same model in the world of value investing, and it seems, if I'm correct me if I'm wrong, it seems to be working right now, and there'll be many more manifestations of the same thing. You see, don't blame the model and don't assume that they're always going to work. These are not laws of physics. These are not laws, these are models. And notice we are doing social science. So there should be no physics envy over here. All we have is tendencies and probabilities. So when you say that markets are selling at a multiple which is the highest it has ever seen, or close to the highest it has ever seen, you can go back to in the past cycles and see what happened in the previous 15-20 years and what are the forward returns going forward, and you'll see that, well, maybe it's not that good, maybe the returns are quite negative if multiple goes to that level. That is information for you. Whether the mean reversion will happen today, tomorrow, you don't know, but the probabilities are in favor of mean reversion. The odds are in that direction. Right? That's the point I'm making here. You're not certain, but you're just using a tool to help you think through this. That this is a dangerous part cycle of the market, and I want to be careful about it, and I want to be careful about the asset allocation for my clients. How much of the money should be in equities? So I'm going to be careful about that. So that's one way of using that. The other way of using that, as we talked about, was thinking about businesses and cycles. That cycles turn. If you are investing in a cyclical industry, then we know that almost all shortages are going to be followed by gluts for all sorts of reasons that we have looked here. So the mean reversion model comes in play not in isolation, it comes in play with the help of a combination. It comes in with the combination that you're combining it with the models on psychology, that they will turn. And you're being careful that you're not predicting when the cycle will turn. You're not. So there are two questions to answer: what will happen and when will it happen? Whenever you have these two questions, forget about the when will happen. Don't try to time markers. Don't try to predict, because again you're trying to make a prediction about the behavior of other people. You're basically saying that this cycle is on the downside and it's a cyclical industry. The Tobin's Q has gone down. The value of the assets in the stock market is way below the replacement cost of the assets, and these assets are not belonging to an industry that is going into oblivion. They serve a very basic need. It's a cyclical industry. There is consolidation that is going on. There are some players in the industry which are strong. They are buying out other players, and demand will continue to grow over a period of time. It's only a matter of time when this glut will go away, and eventually it might become a shortage. The cycle will turn. I don't know when it will turn. And then the next question becomes, you can then think about investing in the lowest cost producer in the down cycle, because they are still making some money as compared to those who are not making any money. So you're betting on mean reversion, and you're combining it with the lowest cost production, and you're combining it with a reasonable valuation based on average earning power, not the lowest earning power. You will actually be paying high multiple of recent earnings, because that's the way the P multiples of cyclical companies work. Or you can use Ben Graham's high cost producer model. He said, if you have a view about the price of a commodity that is going to go up because the cycle is about to turn, then the best thing to do is to invest in the highest cost producer and the most leveraged player. You can check out security analysis, there's a whole section on that. Philip Fisher disagreed with that. He said, I don't want to predict where cycles are going, where commodity prices are going. I want to be on the safe side. I want to only invest in the lowest cost producer. He has a whole chapter of that in Conservative Investors Sleep Well. So I leave it to you, whether you want to follow Graham, you want to follow Philip Fisher. Both of them are betting on cycle turning. One of them is saying, I know when it will turn, because otherwise, if you're a levered company and high cost producer and the cycle doesn't turn, you could die. So it's but both of them are betting on mean reversion. So mean reversion is a very powerful force. Some things mean revert, some things don't mean revert. A great business will keep compounding money over a very long period of time. So there is no mean reversion there. Mean reversion will happen because if a business is doing very well, it will ultimately attract competition. So if your original analysis was superficial, that the ROE is very high, the business ROE of this business is very high, or ROC is very high, and it should go down over a period of time. Only if there are no entry barriers. If there are no entry barriers, then mean reversion will work. But what if there are when there are strong entry barriers, there are high switching costs, the business has pricing power, they have great execution skill, they have a product that people want, and there is no competition inside, and no competitor wants to enter the market, and they have mindshare of the customer, all the things that we talked about. When you have that, then you can abandon mean reversion because it's not relevant. There the momentum comes in. So you have now two models. You have fundamental momentum, which is a model from physics, and then you have mean reversion, which is a model from statistics. So so why to be stuck up with just one model when you have so many others to work with? So you have to look at what are you looking for. Are you betting on mean reversion? Are you betting on fundamental momentum? So if you invest in a great company which is going to compound its wealth over a very long period of time, and then you apply the model of mean reversion on that, obviously you will get the wrong outcomes. And then if you say, well, this is a great company which will do very well, but it turns out to be a cyclical company, and you apply the methods of evaluating a compounding machine on a mean reversion business, you will get bad outcomes. So you're fitting the wrong model on a different this thing. So you have to really understand what are the various models and which is the right model, which is the right tool to use in which circumstances. All right, this is fun. It's been fun, and I'm so glad that we did this. And I hope I'll see some of you in Flame Campus. And even if you don't see me, there is a lovely Flame Campus, as Arpan will tell you, I'm sure. And if you want to know more, just get onto the Flame Investment Lab website. There are lots of courses over there done by a lot of wonderful investors who come down on the campus. I'm sure you're pretty bored of me right now. Has had enough of me, so you can go and subscribe to the courses being offered by many other speakers. There's a whole program of masters which is there, and you will absolutely love the campus. So thank you for having me here. It's been a pleasure and honor to be. Let's make sure that our countries remain as friends. We are very short of friends, so thank you for that. Thank you so much.